Good morning and good afternoon. Welcome to our apartment market update. My name is Hessam Nadji. I'm Managing Director of Marcus & Millichap. I'm joined today by Bill Hughes, who is the head of our Capital Markets Division, Marcus & Millichap Capital Corporation, and John Sebree, who is the National Director of our Marcus & Millichap National Multi-Housing Group. It's our pleasure to be hosting this program. Our job today is to give you an update on what's happening with the broader economy, apartment market supply and demand, as well as capital markets and apartment investment trends. You will see on your screen you have the option of submitting questions to us throughout the presentation. I'll be monitoring those questions, and the three of us will be addressing those that are submitted by you. If at any time during the presentation your screen or your sound freezes, please use the F5 key to unfreeze. And you also have an option on your screen to download the slides that are provided as part of this program. To begin with, my job is to give you a quick update on what's happening with the broader economy. And the most important news of late, of course, is the Federal Reserve quantitative easing 3 that was announced last week. Since our last update, in addition to the European Union's recent step to backstop the European debt crisis and the deepening recession in Europe, this is the most significant development on the macro front, coming on the heels of what Europe finally stepped up to do in limiting the contagion of the European debt crisis. The 1-2 punch effect of what's happened on a global scale is important. The Fed coming out and announcing a $40 billion a month purchase of mortgage securities, but along with that, not announcing a end date or a deadline is very significant as it reflects the commitment to keep interest rates very low here in the United States. In addition, they have committed to keeping short-term interest rates low for an extended period of time, now until 2015, sending yet another signal. And lastly, continuing Operation Twist, which is a mechanism by which the Fed is purchasing long-term bonds and selling short-term bonds in order to keep long-term interest rates low. All of this is specifically stated to be aiming at reviving the labor market and improving job growth. And that is directly being measured as a reflection of an improvement in housing, which low interest rates are expected to provide, as well as keeping the dollar low and keeping our exports going. Exports have been a big contributor to this recovery so far, and the Fed's intention is to keep that going. So combined, this is a significant development in terms of our low interest rate environment and the accommodative stance that the Fed has taken. If you've been monitoring our reports and joining previous webcasts, you've heard me talk about the fact that we have long believed that the fundamentals of the U.S. economy had improved to the point where the 2 or 3 cycles of recession concerns were not going to actually materialize into recessions, and that the macro clouds creating a lot of uncertainty have held back an organic cycle where a muted recovery would turn into an expansion. The fundamentals had improved, but the level of uncertainty that has existed throughout the last 18 months has really kept companies from being aggressive regarding growth and employment and investment in the future. And I think the developments that I just recapped, coming from Europe, coming from the Fed, help to alleviate some of that uncertainty. However, we have an important cloud still remaining, and that is the so-called U.S. Fiscal Cliff. That is the expiration of the Bush-era tax cuts, as well as automatic spending cuts that are scheduled to go into effect January of 2013. If allowed to happen, the fiscal cliff will deliver about a 5% hit to the GDP, to the U.S. GDP, which is a significant amount of pressure on an already fragile recovery. There is a lot of debate. There is a lot of question marks as to whether Washington will be able to get its act together, especially during a lame duck session coming up after the election, to prevent or at least mitigate some of this impact coming from the fiscal cliff. So that still remains a bit of uncertainty for us. But taking a look at the fundamentals again as an update since the last time we presented this overview, retail sales in the United States, which account for over 70% of our economic activity, continue to grow. There's been some choppy months. There's been a few pullback months. as consumers got concerned about all the headlines turning negative again. But overall, retail sales in the U.S. are 8% above where they were at their 2007 peak. Even if you look at it on a per capita basis, given the fact that our population constantly grows, retail sales are up about 5% from their 2007 peak. That's a significant solid footing that is reflected in those retail numbers. On the employment front, as much disappointment as we had over the past few months on the muted job numbers, if you take a look at a 12-month period, two things really come to light. One is that we've added almost 2 million jobs over the past 12 months in the private sector. And the fact that those jobs are being generated by a variety of different sectors. It isn't just one or two sectors that are creating jobs in the economy. We have professional and business services, education and healthcare, leisure, hospitality, trade and transportation, and even manufacturing, adding about 200,000 jobs. This is significant and ties back to the export component of this economy that I commented on before. So we have a broad-based set of industries creating jobs, granted at a muted pace. We have the consumer at least creating a footing for the economy. Now we're beginning to see some of the macro clouds at least start to break. If we get through the fiscal cliff with an extension or at least a minimization of the direct and immediate impact of the economy, 2013 should show better results in terms of the momentum of this recovery. The job numbers by metro are very interesting to talk about. Last time we held this program, I noted the trend of metros that are directly linked to technology, energy, exports, and entertainment, being those that tend to be leading. The pattern pretty much holds. You can see Houston and Dallas topping the list at 60 and 83,000 jobs respectively. Los Angeles, New York, and now Phoenix, which has joined the top performers group, coming in somewhere between 40 and 60,000 jobs. And even markets like Denver entering the top 10. And markets that are not shown here because they just fall short of the top 10 include Minneapolis as well as Detroit. Detroit has added about 30,000 jobs. Atlanta now has added 30,000 jobs in the past 12 months. So we're seeing a broadening of the better performing metros in terms of jobs. On the right side of this graph, you see those metros that are still lagging. An interesting pattern to note there is the severity of the housing crisis in Florida is still an overhang. The Florida markets still have not kicked in. It is really just a matter of time before Florida joins the leading job-creating markets, and maybe 2013, 2014 before that happens. And, of course, some of the Midwest markets that have not had much of a catalyst, not benefiting directly from the manufacturing revival that we've seen elsewhere. As it relates to the apartment market and as it relates to the Fed stated goals of trying to support the for-sale housing market, we are beginning to see the for-sale housing market move beyond the bottom. There's been a 10% increase in the number of existing home sales on a year-over-year basis, a 10% increase in the median price of homes. Housing in general, for-sale housing in particular, is an important indicator in that it's typically a much bigger contributor to an economic expansion that we're experiencing today. For-sale housing only accounts for just short of 3% of GDP, whereas exports are accounting for close to 12% of GDP. And this is one of the elements that needs to change to get a broader economic recovery. However, at the same time, lending standards are still very tight. A lot of consumers are still not psychologically ready to buy homes and favoring renting. The bottom line is that we expect the for-sale housing market to continue to recover, but not at a rate that is going to basically derail the favorable fundamentals for the rental market that we're seeing. The home ownership rate is still moving down, and there's plenty of demand, and there's plenty of depth in the demand to support both the housing, for-sale housing recovery, as well as the continuation of a very strong rental market recovery. If we advance the slide to the next trend, we seem to be having a technical difficulty here with the advancing of the slides. If you can move on to the next slide, please. Thank you very much. The absorption patterns for the professionally managed apartment market have really been exceptional since this recovery began. As we've covered in previous reports and presentations, absorption really set some new records coming out of the 2009 downturn due to the release of pent-up demand, favorable demographics, the falling of the home ownership rate, and the psychological preference to rent, which I still believe that is more of a long-term shift than it is just a cyclical shift. The numbers were off the charts, stronger than any period in recent history. And they have leveled off. We've seen absorption slow down to about 30,000 a unit per quarter, whereas in the last 18, 24 months, we've had quarters with as much as 60 to 90,000 units absorbed. But nevertheless, this is not alarming as we have returned to more sustainable and normalized levels of demand. And because of the supply side of the equation being pretty much in check, we're expecting the current very favorable dynamics in the apartment market to continue. In fact, it is safe to declare that we have regained pre-recession levels of vacancies across the country, across the entire apartment sector, with the Class A sector having led the recovery, and now with the B and C category of properties catching up. And it's interesting, if you take a look at the NOIs and revenue growth expectations, the A product has been leading by such a margin that there's a leveling off effect occurring at the top end of the market, whereas the B and C sectors of the marketplace are just coming into that sweet spot of very, very strong rent growth and occupancy improvement. The construction side of the equation at a macro level stays very much in check, with just about 85,000 units expected to come online this year, maybe about 110,000 next year. There is quite a mixed bag of local trends. Some of the metros are beginning to see a lot of new product come online. Many metros are well short of new product coming online. The new product that is coming online is ultra high end and not really affecting the workforce housing or the middle of the bell curve of where the demand is. So overall, we do not expect building to become an issue whatsoever. However, in terms of the mix and in terms of the local metro trends, and especially submarkets, we could see some gyrations because of the amount of new product that is being built in certain locales. Everybody always asks for an update on this slide, and here we're showing the lowest vacancy metro areas on the left, and the highest vacancy metros on the right. The patterns are not too surprising. You know, the coastal markets that have traditionally been supply constrained have basically regained their ultra-tight vacancy rates. Portland, New York, Minneapolis, which is an interesting Midwest market, now showing 2.4% vacancy rate. San Jose back down to 2.5%. San Diego at about 2.9%. And even a market like Milwaukee now coming in at 3.5%. Very interesting patterns on the low vacancy side of the equation. And on the higher vacancy markets, what's noteworthy is the degree of improvement that is happening with vacancies in traditionally high vacancy markets. I want to point out Texas in particular, which, because of its job growth and because of an unusual limitation on new supply coming out of the ground, at least for now, we're seeing very robust drop in vacancy rates that you can see on these market rankings. We even have pretty big drops in vacancies in some of the Florida markets. So it is fair to say that there is a broad and sustainable recovery pretty much touching all metros across the country. Definitely primary metros. Some of the secondary metros are joining in. However, the question becomes, when do some of these markets start to build too much again? And that's, of course, a concern that we always monitor in the more volatile, construction-heavy markets. So with that, before we move into the capital markets part of the presentation, I'd like to open it up to any questions or any topics that I may have left out in the economic overview.
Yeah, Sam, I guess I know that certainly you paint a fairly decent picture, particularly for the multifamily arena, but also there are clouds out there economically. We've got the Fiscal Cliff coming up. I know that you and John both attended the National Multi-Housing Council Board of Directors meeting this last week in Washington, D.C., and I know you met in a number of sessions with a number of congressmen and senators. What's your take of all that? How are they feeling about getting along and making changes, and how's that impact where we are today?
Well, I'll jump in and eager to hear John's comments as well. I think NMHC did a phenomenal job of exposing the industry to a variety of lawmakers' perspectives. We had 11 lawmakers come through in a 2-day period and really update us on their thinking and what the challenge is. The couple of things that became very, very clear is that everybody's aware of the severity of the fiscal cliff and what it could do to the economy if left ignored or unchecked. Everyone still has very fresh memories of what happened last year with the debt downgrade and how much potential damage that could have done, although the damage ended up being very limited, if any, because the U.S. is still the gold standard globally, and with a lot of global uncertainty, capital still continued to flow into the 10-year Treasury, keeping our interest rates very low. But it was quite risky as far as the process and what went down last year. I think there is so much awareness of the severity of this problem and what happened last year that there seems to be a willingness and an acknowledgement that we cannot just let it happen. There is a lot of tone about bipartisanship and compromise, although, of course, history does not bode well for that really coming to life. So we do have a lame duck session coming up after the election, but the attitudes seem to be that even then we need to get going and deal with the fiscal cliff in some way. It doesn't all have to be ignored and kick the can down the road all the way. I think if there's at least a minimal delay until whoever is in the White House and however Congress is reshaped can get settled in and deal with the problem. And it also seems that tax reform, along with doing something about the fiscal cliff, is very much on the agenda now. They're kind of tied together. But it's a cloud. It is definitely a cloud. And given our history, just judging by that, I think we should remain concerned. No clear answer came out of our sessions. John?
I completely agree, Hessam. I think that it was very interesting to listen to the perspective of the different senators and congressmen as they came in and talked. I think that we definitely have an issue with the fiscal cliff. I think that everybody acknowledges that. I think everybody is trying to work towards a solution, but it's going to take some compromise on both sides, and it's going to take people coming together. And I think that's the one thing I took out of it. It's got a little.
I think the probability of more compromise this year than there was last year is at least a little bit better.
I completely agree with that. Yeah. I think that, my personal opinion on that is, I think that so many of these people have heard back from, the people in the districts that they represent, and just becoming very frustrated with, again, on both sides, but with the fact that we've had a couple of times where everybody's dragging their heels, and that hasn't benefited anybody.
The added angle to all of this is that not only do we need to deal with the fiscal cliff and deal with more of the long-term, a progressive long-term solution to the debt, we have to do it in such a timely manner that we don't get another downgrade. That's another thing that kind of looms beyond the immediate challenge. So we have our hands full in terms of challenges coming out of Washington. But I want to emphasize that the fundamental organic U.S. economy is in solid shape. It's just a matter of removing these anchors from this organic recovery, which should becoming an expansion. That's the challenge. I think we're ready to go if we can just undo the anchors.
Right.
Well, certainly the timeline's coming up. Something's got to be done, and I guess that's the good news. I wanted to talk a little bit this morning myself about capital markets and provide everyone with a overview and outlook. And while doing that, I hate to sound a bit like a broken record, but looking back over the last 6 months or so, other than a little interest rate volatility, there's been very little to change in the marketplace. This morning, we're going to take a look and talk a little bit about interest rates, the availability of debt and equity products, capital providers, challenges we see in the property sector, quite frankly, few. And we'll give you some thoughts about where we think the market will be over the next 6 months or so. Certainly, the historically low interest rate environment has driven activity in the marketplace. It's driven returns and value. We've seen generally strong property fundamentals have attracted debt and equity to the sector. Availability of debt continues to be widespread. A to C quality assets in large secondary and even tertiary markets are available for multifamily borrowers. Underwriting has remained pretty consistent. Lenders are focused on stable occupancies and underwriting of income stream. One issue, new construction, is becoming a point of concern. Can tenants pay the necessary rents to justify a new project? What's the depth of the market? Both equity providers and construction lenders seem to be turning a little bit more cautious, particularly when they've already done a deal in the marketplace. It's a little bit more of a let's wait and see attitude than let's jump back in and move forward. And we've seen that change really occur over the last 60 to 90 days or so. Debt service coverage of 125 to as low as 115, producing loan to values of 65 to 80% most certainly. Capital stack in this instance is served by agency lenders, Fannie, Freddie, HUD, life insurance companies, local and regional banks, private and public funds. CMBS hasn't been in the game, but we've seen their spreads move their rates within today almost 20 basis points of where a fully leveraged Fannie Freddie deal might be, so we're starting to see a little bit more play there. I wanted to take a little bit of a look at sources of apartment acquisition financing. Clearly, the agencies have been the largest providers of debt to the multifamily sector for a long time now. Commercial banks have certainly become more active, increasing volume to 20% of the market in the first half of the year. Life companies' activity at 9% in the first half of this year certainly has increased steadily since 2009. I think that bodes well. I wanted to look at mortgage outstanding debt. In this case, while the GSEs clearly own this airspace with over $352 billion outstandings, banks have increased their outstanding debt since the first quarter of 2011 by $7 billion to $221 billion. Life companies have remained stable at around $50 billion over the last 10 years. CMBS is the only debt provider that has not been active in the multifamily sector, reducing outstanding debt from a high of $124 billion in the third quarter of 2007 to $88 billion today. Clearly not an indication of interest, but rather more an indication of their ability to compete with the other players in the marketplace. Core inflation today. Did I skip a slide here? Let me go back here. I'm sorry. Sort of confused myself. I wanted to spend a little bit of time. Hessam talked about QE3 and the stimulus. This is a timeline of various stimulus through the sectors, certainly from QE1, QE2, Operation Twist, and now the announcement of QE3, what really happens there. The important part of this slide is the direct relationship between unemployment and the different stimuli. In each case, stimuli has impacted employment positively. We've seen a long-term decline in the 10-year Treasury to historic lows. That's certainly been positive for us, and we expect it to be positive moving forward. While we don't know what the outcome of QE3 is, I might refer to it as QE3 light. We don't expect it's going to have the impact that certainly QE1 did. We saw a fall off in QE2. Quantitative easing has certainly helped the long end of the bond, long down rates. But QE3 is questionable. Quite frankly, its focus on the housing sector, its focus on residential, getting people to buy homes, hopefully improving construction activity, which has been lacking in this recovery, will create new employment and will do a lot for us. I'm not so sure it's going to do much in interest rates given where we are in historical lows, but nevertheless, I do see it as a positive, well-focused stimuli. I wanted to take a look at core inflation versus the 10-year Treasury. You'll notice that the relationship between the core inflation chart and the 10-year line has been fairly direct. It runs in unison up until really the summer of 2010. We started to see a breakaway, and that was a direct result of some of the concern of the marketplace. That's a fear factor. It has to do with global issues, the euro debt crisis, certainly choppy economy here, lack of sustained employment. Where are we going? Where are you going to put your money if you're an investor? Let's pick a safe haven. Let's go to the 10-year Treasury, driving the 10-year Treasury rates certainly to all-time lows, certainly below their 40-year averages, below their 10-year averages. We're going to start seeing this move up a little bit. Last few days since QE3 was announced, we have seen the 10-year Treasury move up. We should be sitting, I looked this morning, at about 180. I could see that moving up further. We think this year that it should be range bound on some basis, and I'll talk about that in the next slide. Here is the 10-year Treasury. I took a look at it since March. You can see the volatility in the marketplace. I know this looks worse than it probably was, but obviously we moved from a 2% rate to just about a 2.40 rate, fell back down to low 140s. We're now at clearly a 180 level. It is jumped around pretty much like a seesaw based upon European debt crisis, announced numbers, all sorts of different things. But we're in pretty good shape right now. We're where we are. The commercial delinquency rate by lender, I wanted to show this. Obviously, Fannie, Freddie, life insurance companies are very low, historically low. Really, Fannie and Freddie is down where the life companies are. Agencies both under 1% at 0.29% for Fannie and 0.27% for Freddie. Banks have improved from a high of 4.4% in the third quarter of 2010 to 3.11% today. CMBS delinquencies, 8.97%. The good news is the rate of increase has dramatically slowed since the second quarter of 2010. From the first quarter 2009 until the second quarter 2010, the CMBS delinquency rate increased by 6.36% to 8.22%. Since that point, we've seen simply a 75 basis point increase, a much slower rate as we move forward. So I wanted to take a look at investment considerations, talk with you a little about things that you should be thinking about in the marketplace, and to give you a little bit of outlook of where we are. Debt and equity markets, we expect them to remain stable and accommodating to the multifamily sector. Challenges include certainly a choppy domestic economy, employment numbers. Are they slowing? Are we going to improve? Is QE3 going to get the reaction that the Fed would like it to get? Inconsistent economic indices. 1 minute the manufacturing index is up, the next minute it seems to go down. These things don't provide the consumer with much confidence, don't provide market observers with much confidence, and it is a problem. Certainly we have an election coming up which impacts the market. We certainly continue to have global influences, foreign sovereign debt. We have economic geopolitical uncertainty globally. This low interest rate environment, how much lower can it get? We've seen some lenders really pull from the market because they can't get the returns they need. They're not going to be as aggressive. And lastly, the future of inflation. What's going to happen? When did it take effect? Can the Fed control future inflation? Capital supply to remain healthy and open throughout the sector. Certainly agency lenders, Fannie and Freddie, have really pushed their volumes out. We see no pullback in that we think they're going to remain pretty aggressive through 2013 in the marketplace. Life insurance companies, there's a role for them. If we can get rates up a little bit more, I think we're to see life insurance companies become more aggressive in the sector. Certainly best quality assets, they're not going to do stupid things in terms of underwriting and pushing dollars out. Regional local banks will continue to make a march on the market. I think they'll continue to grab market share. They will increase their activity in the marketplace. There's plenty of cash there. It's inevitable that that's where they're going to go with their money. And certainly public and private funds providing higher leverage debt, moving into equity markets, and providing borrowers the ability to recapitalize, to buy value-add transaction. That's all available to the multifamily sector. So let's look at, if you're an investor, what do you do? 1 to 10 million, Fannie small balance is appropriate. Commercial banks, a few life insurance companies are available to you. Generally 75 to 80% financing, 3, 5, 7, and 10-year terms with 30-year repayment schedules. 5 years going to run you today 3.25 to 4.5. 7 years 3.5 to 4.75. 10-year 4 to 5.5%. If you were in the next sector up, but we're going to sort of break these up, 10 to 20 million. GSEs, Fannie, Freddie, HUD, full assortment. Commercial banks, life insurance companies, a few debt funds operating at higher debt levels. CMBS will try to compete in this arena. We're not sure they're going to get there competitively, but they will try. 75% loan to value. As stated, Fannie's programs go up to 80. Really not there quite yet. 3, 5, 7, and 10-year terms with 30-year repayment schedules. Larger deals, 5-year rates a little lower, 3.15 to 4.25, 7-year rates 3.5 to 4.5, 10-year rates certainly 4 to 5.25, and then you get over the $20 million. There's capital chasing deals, full assortment of capital providers from agencies, large national banks, life insurance companies, debt and equity funds, operating all along the entire capital stack. Yes, even CMBS will get involved in larger transactions. There are deals for the CMBS arena to compete in. There's certainly an abundance of low-cost capital available for good quality assets in primary and secondary markets. And for most of you, financing should not be a problem as we move through this year and into 2013.
Great. Bill, the most commonly asked question, we're already starting to get a bunch from investors on the call, is what will happen to Fannie and Freddie? It's been such a differentiating factor for multifamily during the crisis and kept the market liquid and still a significant part of the marketplace. A lot of talk about restructuring those agencies and how will that affect multifamily, and I'd rather you answer that than me.
You mean Fannie Mac or Freddie Mae?
Yeah, right.
Certainly it's been talk in the House for a long time. It's a problem. Unfortunately, I think few of our senators and congressmen differentiate between RMBS and CMBS, or I should say, most importantly say the multifamily product from the residential product. I think there's a number of associations, National Multi-Housing Council, MBA, are working to make sure they understand the benefit of the
a lot of progress made based on what John and I saw.
I completely agree with that. And last week we heard several of the congressmen who brought that up because the multifamily side of the Fannie Mae and Freddie Mac, or the multifamily delinquency within Fannie Mae and Freddie Mac is less than 1%.
Well, you just saw the numbers. They're way less than 1%. They're under 0.5%, quite frankly. And ultimately, what I hope for and what I think is the multifamily sector has been a profitable operating unit for both Fannie Mae and Freddie Mac. Hopefully that comes through. I think it's an appropriate place for the government to provide housing subsidies in multifamily. I think there is all the reason in the world that we believe that they will continue on some basis. But we do know there is going to be a change. Whether or not they're combined, whether or not they continue associated with a government, whether they go private is anyone's guess, and that's the uncertainty of the market. Right now, I look at the remainder of 2012 and 2013 and maybe in 2014. I'm not overly concerned about any negatives hitting the Fannie or Freddie arena, but I certainly believe that once we get a new administration in place or an old administration that's seated for the next term, they will start to deal with it, but probably not well into 2013. It's nothing that has to be resolved today. I think there's a lot of pressure on the residential sector, and obviously with Bernanke doing what he did and trying to buy RMBS, I don't think the government's, that's sort of a hot potato. They're not going to go real hard at that real fast.
Understood. John, any comments about Bill's comments on inflation and interest rate expectations? Because it seems that your forecast confirms the notion that 2012, we're pretty much range-bound. Maybe in 2013, if some of the initiatives by the Fed and some of the reduction of the clouds of uncertainty from the global factors are removed, we get past the fiscal cliff in one piece, the economy should do better. And by middle of 13, if all that is happening and we're adding 2.5 million jobs at an annual rate versus 2 million or more, are we going to get inflation? And does the inflation fear worry you about cap rates?
I don't think that a little bit of inflation is going to hurt the apartment industry. I think that a lot of investors that are going into the apartment industry right now and purchasing apartments are looking a little bit more long term, and they're anticipating that they're going to be able to get some rent growth going forward, and that rent growth is inflation. And I think that cap rates are going to stay low as long as the Treasury stays low. As Treasury starts going up, the cap rates will go up. But I anticipate that the pace of rent growth will bode very well in that.
Great. Should we move on to the investment section?
Absolutely. The next slide goes into the apartment investment trends, and thanks to improving fundamentals, incredibly low interest rates have seen sales volume of apartments surge from a low point of $23 billion in 2009 to $65 billion last year. The rise in activity continues this year with $42 billion of sales in the first half of the year versus $27 billion in the first half of 2011. What's interesting is that large institutional sales, which led the recovery, are leveling off. Private investor-dominated sales in the $1 million to $10 million range are showing increased sales activity and price appreciation. Strong investor demand has resulted in the national average of apartment pricing moving very close to its 2006 peak. This is an increase in value of about 33% from the low point of the recession in 2009. This demand has also pushed cap rates down near their pre-recession levels. The institutional capital flows I discussed earlier are reflected in the sharp price movement in the 20 million plus sales category, which, as you can see on the graph, have returned to pre-recession levels on a per unit basis and are leveling off. At the same time, the pricing for mid-sized properties in the $10 to $20 million range and the $1 to $10 million range are just starting to rise in a meaningful way. This means that private investors who dominate these categories are believing in the recovery, and the good news is that there's still plenty of upside left. One more layer of pricing trends peeled back shows the spread between Class A and Class B and C assets, which is fairly wide, unlike the 2005-2006 market peak when there was barely a spread. Class B and C cap rates have not come down nearly as fast as Class A due to the risk factor, but we expect this to narrow as more investors pursue Class B properties and in search of value-add opportunities and higher yields. Cap rate trends among types of markets mirror the institutional and major private investors' appetite for the best-of-breed properties throughout the recovery, which has created a sizable cap rate spread between primary markets, secondary markets, and tertiary markets. We are now actively seeing capital, both private and institution, move into secondary markets in search of yields, but not quite as much into the tertiary locations yet. This slide is very interesting. One of the questions we get is if cap rates are getting a little bit too low, or if it's getting a little bit too squeezing returns a little bit too much. This graph is very interesting because if you look at the 10-year Treasury, the gap between the 10-year Treasury and the current cap rate, you've got about a 430 basis point spread. And that translates into a very high levered return for investors going in on the front end. So even though cap rates have come down considerably, the return that investors are getting today is still higher than it was, a lot of times higher than it was in the first couple of years than what we saw back in 05 and 06. Hessam?
Thanks, John. One thing to also point out on this analysis of the spreads is that if you look back historically to other times when the spread was large, never as large as it is today, that would point us to 1992, 1998, and 2002. And if you had a time machine, who wouldn't buy more apartments at any one of those points of the cycle? So there's a lot of concern about if it's too late. People around the country ask me all the time, have we missed the market? And to me, the answer to that is absolutely not. Of course, it depends on your investment objectives. But even institutional capital, knowing and wanting that they only want to be in primary markets, Class A product at a 4% cap, they have a certain strategy for that. It's a cash flow investment. They know they're going to get institutional capital on the exit. There is a lot less of a cap rate reversion risk. They're 9 out of 10 times very supply-constrained submarkets. For that type of investor and that type of capital need, that sector of the market still seems to work, especially because of these incredibly low interest rates.
I agree, but even so, your comment had to do with investors in first-tier markets. I think that investor going into a more of a private capital investor going into a second or third-tier market is still running into faced with a lot of the same investment parameters, and what they are viewing is the fact that it's a little bit lower cap rate than maybe what they saw a few years ago, but my occupancy rate is still quite a bit higher, and my potential for rent growth is very, very strong because the amount of new single-family home construction is way down, which historically has been a competitor for the apartment market. So as you trend that out, as you go in and make that investment, the long-term perspective of that hold is much more positive than what we've seen in the past.
Great. Let me switch to some of the audience questions that we've been getting. For those of you that have sent questions, we really appreciate them. They're great questions. We'll try to address as many as possible. First question is a really good one in that, given all the good news, low interest rates, availability of financing for the sector, improving fundamentals, construction is in check at a macro level anyway, what is your overall concern for the apartment industry over the next 24 months? Is there a concern? If there was one thing that would worry you, what would it be?
Well, I think you still have to be concerned about the residential overhang, not those properties that are out there that may still be given back to the bank, but the number of properties currently held in banks' portfolios that you really can't get a real solid number on. And if all of the banks, all of a sudden, all the lenders, Freddie Mac, Fannie Mae, decided to push all of that product into the marketplace at one point in time, you might have an Armageddon on your hands. But the reality is, I think it's been a very orderly disposition of those assets into markets to maximize value, to push the rental market. It hasn't impacted. But I think that's a little bit of concern, particularly as we see some of these new properties coming on that are achieving higher rents. How sustainable is that with all this overhang of residential property sitting out there, and what might it do to the marketplace?
Bill, do you worry more about more shadow inventory of single-family homes becoming rentals? Because there are some programs out there to push a lot of that inventory into rentals. Is that what you're mostly worried about?
I guess that's because that would be the competitive thing. The other side of it, anything that competes with a rent, whether it be a sale, and if my mortgage is now $900 or $1,000, and I'm competing against apartments, 1 and 2 bedroom apartments, 1 bedroom apartments in some of the best markets, what do I do? Do I buy or do I rent? Obviously, the buy decision is partly dependent upon whether or not I've got the equity to be able to buy and whether or not I can qualify for a mortgage, which is obviously an issue these days for most people. But it's the unknown of that out there, I guess, that bothers me. I would be, other than that, I would be so bullish on apartments in most major markets, even though in some markets you do have to be concerned about the number of building permits sitting out there, the number of entitlements, how many units are actually going to come to market, what might it do some markets. But that's generally what we deal with every day. I think we all get our arm around that.
I think you make a very good point. You've still got a lot of shadow inventory that is being held. I think that's getting absorbed maybe faster than what we even realize right now. I think a lot of that is being pushed back out into the market. And I think that as it's getting pushed out, I do feel like it's getting absorbed, in large part because when you've got occupancy rates on apartments running at 95, 96% in some markets, that demand has increased. I don't know that I have the same level of concern as you do. I don't know that I have a long-term, I would say of 4, 5, 6 years. I don't think I have a strong concern about the apartment market. I feel like we're moving in a very, very solid direction. A lot of times we're hearing people bring up new construction, but if you really drill down on the new construction, there are some markets where quite a few units are coming up out of the ground, but it's not I think we might have a few submarkets and a few major cities that have some where those submarkets become a little bit overbuilt, but I am not anywhere near concerned about about new units coming online.
I definitely would agree with John more on the shadow market part of the concern, because the audience for that tends to be a little bit different demographic. Usually people who had been in single-family home ownership, who've lost their homes, tend to be renters of single-family homes. The professionally managed apartments are catering to the more younger professional adult and the first-time household formation audience. So I think we're somewhat shielded from that, but I think it's more of a tale of maybe 100 paper cuts, where you lose a little bit of momentum to some home buying. I do believe that given what's happened with the Fed's surgical effort to help the housing market, the for sale housing market, and affordability being where it is, and the fact that people are now beginning to maybe believe that the market has bottomed, there's going to be more home buying and condo buying ahead than there's been so far in this recovery. Plus, you get a little bit of the competition from the shadow market to some degree in certain metros. And probably most importantly is, are wages going to keep up with the level of rent growth that we're used to seeing over the past 18 to 24 months? So if you combine all those together, to me it's more of a few paper cuts that may be forming a little bit of a concern. But
I agree, but I think we also have to look at the fact that the American dream of everybody being in a home, with a white picket fence and a dog in a station wagon, is not necessarily as strong today as what it was before. And there's the question becomes, have we taken a step back and then we're going to continue on the same course, or do we have somewhat of a fundamental shift in our society in the direction we're going to go? I personally believe there's a bit of a fundamental shift in our society. I think that in the future, the possibility of us ever getting back to a 68.5% or whatever the high watermark was on the percentage of home ownership, I don't see that happening. I don't see the desire of people in our society right now wanting to get back to that point.
A lot of people are. I need to be a little contrary to that, because ultimately what I'm most excited about QE3 and the focus on residential mortgage-backed securities and the focus on keeping mortgage rates low for the average home buyer is one of the underlying goals to that is to create added value in the residential sector as a consumer feels confident with the value in their home and their equity in their home. Sure. They feel more confident about the future. And I would tend to argue that as we start to see values go up, that fundamental shift that I agree is happened. Hey, owning a home isn't as important to me, but if we start to see home values starting to accelerate and move forward, we could see that change around again where, maybe it is more important to me to own that home.
To me, I think the reality is somewhere in between both your scenarios, where I don't think we've completely gone to a renter nation, and we're going to lose some, but at the same time, we're going to lose some renters to home buying, but it won't be anything like we saw in the speculative era of 2003, 2004, where people were buying, multiple homes,
right. Right.
because of what was happening. Next question from the audience is addressed to the two of you. We've seen more demand for secondary markets, John, but the question is, are the fundamentals in secondary markets and tertiary markets improving enough to attract investor dollars, and are lenders willing to finance them?
I'll go first and then throw it to you, Bill. The answer is yes, absolutely. The fundamentals in the secondary, tertiary markets have done extremely well. You may not be getting quite as much rent growth as you are in a New York or a DC or a San Francisco area, but you're still getting very good rent growth, and probably better rent growth than you've seen any time over the last 10 to 12 years. At the same time, occupancy rates are very good, and though when we look at job growth across the country, a lot of times we have a tendency to look at the major cities. But most smaller cities are also creating new jobs. And maybe, once again, maybe not off the charts, but those fundamentals are very, very strong. And what investors are doing is they are going into those markets, and I think one of my graphs showed the cap rates on secondary and tertiary markets tend to be quite a bit higher than they are in primary markets. So it's a yield-driven investment. The investors are looking at that. Maybe your occupancy rate is just a little bit lower. Maybe you have to underwrite your long-term cash flow analysis with a little bit less rent growth going forward per year, but you're going to go in at a higher cap rate, and you're going to chase the yield.
Bill, can you finance them?
The answer is we have debt available for almost all markets. There are a few markets that are more challenged than others, but clearly with the local and regional banks becoming more active in the marketplace, they understand those smaller markets, those tertiary markets. Multifamily is doing well. Somebody has to live, that's where they're going to live. So it's pretty good. Unlike other sectors, retail, office, where I wouldn't be able to say that, I can say that in the multifamily arena. We have not had to say no to a financing of a multifamily now for well over probably a year. There seems to be debt for almost anyone.
In that case, then the forecast would tell us that those cap rates in secondary and even tertiary markets are bound to begin to come down as the primary markets kind of level up.
I think they will. And I think that what has happened, I think the institutions were the first ones to jump back into the market, and the institutions jumped back into the primary cities. I think the private investor and the syndication groups and a lot of the investors who are bringing in maybe a little bit of institutional capital with them, but still we're going to classify them as more of a larger private investor. They're chasing yield, and they are now they're getting pushed out of the first tier markets because they can't compete with the larger institutions. But they are going into the secondary markets.
I'm curious, John, whether you're starting to see the coastal capital, the active market capital, start to move into the Midwest, into some of the smaller markets.
Yeah, absolutely. I think in the Midwest and through the eastern part of the country, it's interesting. You end up with a lot of New York, a lot of Boston, a lot of D.C. money coming into the Midwest. Obviously, Chicago's a financial hub, so you can go into secondary and tertiary markets throughout the Midwest and into the Southeast and have money from a lot of those cities. California money obviously would come all the way out. In my opinion, I think California money tends to focus a little bit more on the Phoenix, Texas, Denver, Las Vegas, those markets, maybe not quite pushing as far. That's not to say that they won't, but I think if you lined them up, that's what's happening. To answer your question, yes, again, they're chasing yield. 2 years ago, that coastal money was chasing money in Los Angeles and San Francisco. They can't now compete, or they can't get the yield that they need, so they're going a little bit farther away.
Plus, I think there's more appetite for risk. I mean, we are in much better shape than we were 2 years ago.
Totally agree.
Certainly, I mean, we have a little bit more visibility. We've added 4 million jobs. We lost 8.5, so we have a long way to go. But a lot of the audience members are concerned about rising inflation and interest rates. So let's spend a little more time with that. And the bottom line question really is one that you can answer, Bill. If interest rates go up more than you anticipate, and even though there'll be rent growth to accommodate some of that movement, are lender spreads such that the initial 1 or 2 waves of higher interest rates can be absorbed by lowering the lender spreads, or is there going to be more of a one-to-one correlation for the cost of capital that our audience would have to pay?
Well, I don't think it'll be a one-to-one correlation. There's clearly some room in lender spreads for them to be able to make that happen. But part of the answer to that is whether or not we continue to allow the CMBS marketplace. Fannie, Freddie are going to the secondary markets now to sell their assets as opposed to putting them in their portfolio. So, they've got an issue where they've got to sell their product into the marketplace. And so I think that the reality of it is that, the Fed is pretty smart. They've had a watchful eye for a long time on inflation. I think as soon as we start to get any rapid growth, rapid employment factors, I think you're going to see Bernanke turn back, even though And here's the benefit of QE3. He didn't have a finite timeline. He basically $40 billion a year until I need to. The need to could be in 2 months to start shutting it off. Right. And quite frankly, I'm going to say that he could shut off QE2 pretty quickly if they needed to. I don't think that we are moving around where we're gonna see employment all of a sudden jump up to 300, 500,000 a month. That's the kind of thing that would take to really, I think, start to really make a huge jump in inflation, catch everybody off guard. I think everybody thinks it's more sustained. I think it will hopefully be increasing. But I think the Fed is well prepared to deal with sustained turnaround that's pretty consistent, and they're going to know when to turn off the tap. At least I certainly hope so.
Sure. One of our long-term institutional clients sent in a note, and he and I have had this discussion before. I think it's an interesting one to share with the audience, and that is, as the economy improves, let's say that the fiscal cliff is resolved, and we get a little bit more traction with the job growth numbers and so on, and we see better performance in the other sectors, retail, office, in particular industrial. The industrial market, of course, is doing much, much better than it was, and reacting almost with direct correlation to GDP and movement of goods and trade. So would it make sense for a lot of investors to opt to invest in industrial and office, retail, versus apartments? And by the back half of 2013, we're going to see some capital shift away from apartments and prefer to buy the other improving sectors. Is this something you worry about, John?
No. I think it's possible. I think there's obviously a lot of money chasing multifamily right now. I think that if you look at multifamily on a 10-year forecast, or looking at the amount of new single-family home construction that's being built right now is very small. The occupancy rates are very high. Rent growth. We've had strong rent growth really the last couple of years, and new construction is somewhat limited at this point. I think people that are looking at and investing in multifamily, again, I think they're looking out very, very long term. I'm not an expert on industrial or retail, but I think that it would have to come at a cost to the value of the industrial and retail. In other words, if they could price those cap rates high enough to maybe pull some of that money away.
There's certainly a spread. I mean, quality industrial or quality office can trade at a 6.5 to 7 cap or 6 to 7 cap versus similar quality apartments trading at a 4 cap.
Right.
So there's certainly a spread. But I see your point about the risk adjusted component of looking on the horizon. Bill, any comments on that?
I think there's always a certain number of investors that chase yield, irregardless of the property sector it's in, and you're going to certainly see some number of people do that. I think the other equation is that lenders have gotten pretty smart about knowing who the right borrower is, and the right borrower is somebody with an experience level with that type of property. It's a different bit of a skill set, understanding retail and the nuances of tenancies and how to attract tenants versus industrial, and who are the tenants and who are the better users and what do the locations look like. I think it's a whole different field. Will some of that happen? Oh, certainly. Will it be widespread? I clearly don't think so.
Great. That makes some sense. Last question, just in respect to our time limitation, is about construction costs and availability of labor. It seems that there is a lot of natural barriers to construction, both on the cost part of the equation. Seems like material costs are up 15 to 20% over the past 12 to 18 months. And especially if the for sale housing market really begins to catch on, there's more construction, then there's going to be more competition for labor. Are you seeing anything out there? Would you consider what's happening out there as a restraint, as a natural break on multifamily construction, John?
At this point, no. Now, that could change as we start working through this cycle. I think that part of the reason that construction costs are so much higher right now than maybe what they were several years ago is because of where people are building. The amount of new construction that is taking place in urban infill locations today is much different than 10, 12 years ago when all the new construction was suburban sprawl, go out to the edge of development and buy the next plot of land. So I think as a result of having to come into a core location, that land is more expensive, the entitlements are more expensive, the labor is more expensive, and as a result, they're building a little bit better quality of asset.
Great point. Bill, anything to add? Construction financing widely available?
Well, it's not. I think, the only really property sector that has been available in, as a general statement, has been multifamily.
Yeah, right.
And I think lenders are becoming more cautious. They're concerned about that rent that the renter's going to have to pay.
Right.
They're concerned about the jobs that are needed to be able to sustain that rent in the future. They're concerned about depth of markets. Equity players are concerned about it. Lenders are concerned about it. And that's an issue. I think it's going to keep a cap in some markets, and in others that demonstrate a real demand, I think you're going to see a little bit more. But I just don't see this thing running away from us. I think lenders right now are still pretty skeptical about the future. And as far as costs are concerned, you have to remember that most deals that are being built on land that's a lot cheaper, where they acquired it a lot less expensively than they would have acquired it 3, 4, 5 years ago. And so there probably is a little bit of room, but there is a balance that has to occur, and it's too early to tell, quite frankly.
Great comment. With that, we'd like to thank you for joining the session. For all the participants that sent us questions that we didn't have time to get to, we will respond to you via email. Thank you for your time, and we look forward to our next session with you. Thanks.